the data that banks have and the stuff you can do with it is absolutely incredible. And we could pick the one person who spent the most on McDonald's in the whole of the UK and single this person out. And I was like, man, I lied. That is it was the trip frequency and the average spend was through the roof.
We don't have that.
Yeah. Just to be clear.
We aggregate our data and we certainly don't have people's names.
Welcome to Checks and Balances, brought to you by Partners Life. I am Michael Vincent. This is James Blair. And today we've got Jarrod Kerr, Chief Economist at Kiwibank, back for his second podcast. It is WWJD, What Would Jarrod Do?
So Jarrod, welcome back.
Cheers.
Yeah. How do you feel about the
intro?
Yeah.
WWJD?
Yeah. Does that
very
come
good.
up very often?
Yeah. Like it,
Yeah. We'll stick with it. So make sure to go check out the previous episode we did with Jarrod, where essentially we got an understanding of where he thinks New Zealand is at the moment. What are the key factors moving forward? We're going to go from quite macro to Jarrod focus on what would Jarrod do based on the current environment. So I've got a few questions to ask you. The first one is, if you had $1 million in cash, Jarrod, right now, what would you do with it?
If you gave me $1 million right now,
yeah,
obviously I'd say thank you very much.
I mean, it's the standard guest fee that any checks and balances.
Oh, right. I'll
be
back next Tuesday.
Georgia or Hawaii, the money.
I'd pay off my loan.
Yeah.
Seriously, paying off the mortgage is probably the best thing to do. And the way I think of it is I'm paying, 6-7% on a $1 million mortgage. In order to do something else, I need to earn, so much more to take on that risk, and then think of it in after-tax terms. It's a very big number you're chasing.
Yeah.
And the amount of risk to get that sort of return, it's just so much better just smashing the mortgage, getting that down to zero first.
Yeah, well, that's good to hear, because that's what I tell clients to do. So it's always good to get some external validation, because your boy needs it.
To be honest, we spend most of the time, because everyone has should I buy gold? Should I do this? What about this? And we're like, please just pay the. It's not sexy advice.
It's the Sharesies accounts.
Yeah.
So everybody's got a Sharesies account, and if you don't have a mortgage, then that's fine. But it's for all those people with sitting with $1 million of debt and then chipping away some money because they want compounding returns. But then explaining to them, you have to make 10% on your Sharesies portfolio. You take off 1% for fees, you're at 9%, 3% for tax, you're at 6%, 3% for inflation, you're at 3%. Your mortgage rate's sitting at 7%, right?
Yeah. Exactly.
Yeah. Okay. So
in a nutshell,
you'd pay off the mortgage. If you didn't have the mortgage, what else would you be doing?
I do love property for long-term, investment, stable income.
Yeah.
So, probably take that million and put it in an investment property. The yield's not very good. The rental yield's not great. But I think of, owning that for 10, 20, 30 years, and then I die, and then, that asset just gets passed on. It's a very long-term, way of thinking about things. And then you've obviously got the capital gains on top of that. If you actually, for those nerds out there, if you actually viewed an investment property as an annuity and said, this is how much money it's giving me each year for the rest of my life, and sort of discount that back, you'll realize it's actually quite a large number, and it's greater than what you're paying for that investment property.
Yeah. And obviously the ability to leverage as well, right?
Is another thing, right?
Yeah.
So if you decide to buy a $1.5 million place, you got a $500 mortgage. Again, smashing that mortgage first. But for long-term investment, I think it's just why Kiwis love it. And the tax advantage is there as well.
Yeah. And what about you look at the historical performance of property as an asset class, which a lot of boomers have done very well. Yeah. If you look going forward, do you think those 5 to 7%, is that realistic moving forward if you think about the key drivers of property prices?
Yeah, I mean, what are we talking about? We're talking about population. We're a very attractive place. We've just imported a record number of migrants, 130,000 net in the last year. Will we continue to get 130? For probably not.
Yeah.
There'll be waves, but it'll be positive. So we will have positive population growth for the rest of our lives. Under most forecasts, UN, IMF, these sorts of forecasters, New Zealand's population never peaks. Now that's important because China's population has peaked. India's population doesn't peak until 2070.
Yeah.
But the growth of these countries that have the higher population growth is simply more and more on your property.
That hurts my brain a little bit when you say New Zealand's population will never peak, because world population, when
I say never,
Yeah.
not in the next 100 years.
Yeah,
of,
okay.
of long.
but within that
serious
100
forecast.
within that 100 years, the world population, is that forecast to peak? Am I
Yes.
making it? Yeah.
Yeah.
Okay.
Yeah.
But those like places like New Zealand, which we mentioned in the previous episode, Kiwis probably take for granted how desirable New Zealand is compared to.
Yeah. So in a nutshell, if we keep importing people the way that we do, then our population doesn't peak. And it's a complete migration story. Because fertility rates and our natural population increase is falling.
Cool.
But we fill those gaps with people from offshore.
Yeah, we often look at it when we're talking about house prices and predicting them and where they're going to go and talking about them as an asset class. Our customers look at us and go, "There's no way that this house price can double," and we're like, "Well, you just look at Sydney. It's the same thing, same right. It's just a more mature market with higher values."
Yeah. I want to get completely off topic for a second.
Here we
Jarrod.
go.
I want to talk about so obviously we're in the Instagram era, the TikTok era, all that kind of stuff. And from time to time, I hear somebody talk to me about I can buy a mansion in Texas for $500,000 on a quarter section, and it's beautiful, and I've got 1,000 bedrooms. And in Auckland, I get a 1-bedroom apartment for pretty much the same price. Why is New Zealand property so expensive?
It's a good question. I think the worst of it is the lack of infrastructure and supply, relative to demand, has been our biggest problem. It shouldn't be this expensive. There are some geographical things around, we've got, such a large super city, and we put, a lot of people in a very, small area. But basically, I think it's just the fact that we haven't kept up with our population.
Yeah, and if somehow some super smart person comes along and all the reasons we talk about, why we're not building enough houses and why we're not dealing with all these things, if they were, solved with a magic wand or somebody fixed them over a period of time, you bought that investment property, surely that would have a negative impact on the price of that investment property. Do you think that's, a super smart person coming along probably isn't too big of a risk. Do you think it's a risk at all for people who invest in property?
I hope it's a risk.
If these problems get solved,
yeah,
all those Kiwis with investment properties are probably going to be, oh, I don't know if this is a good thing or not.
Yeah, I hope it happens. And I saw it in Australia. So I am the best at picking the top in housing markets, because when I buy, for some reason, that's the top in a housing market.
Yeah.
So I bought my first house in Australia 2007. The world imploded. I bought an investment property in Australia in 2016. And this is the best example I can give you, because the mining boom finished.
Yeah.
They took those people and put them into residential, and they built, thousands and thousands of apartments, actually oversupplied the market. So apartment prices, which is what I bought, fell in 2018, 19, and they haven't really recovered. So, I'm very good at picking the top. But that example is what I would love to see happen in New Zealand, because what they did was actually significantly increase the supply of apartments, and apartment prices fell on the back of supply and demand, not interest rates, not other bits and pieces, but actually catching up and going almost, a little bit too far on the supply side. And we desperately need that here.
Yeah. And I guess you imagine as well, as if that problem is fixed and New Zealanders don't see property as their primary investment and the capital shifts to more productive asset classes,
Very true.
That is a good thing for the total economy. And property itself is not a really productive asset class to invest capital into.
No.
I completely agree. And it's not an even playing field from a tax perspective. Everything you're touching on is true and should be fixed.
Yeah. So, I mean, it's interesting, right? That it's if the system gets fixed, all the people who invest in property are impacted. But
That's the problem. That's the problem no one wants to fix.
It's interesting. And you know, if you're thinking about the political piece as well, when do people feel best? It's when the value of the house goes up, right? They borrow more money, go and do things. You haven't mentioned. You've spoken about property. Spoken about paying down debt. You haven't spoken about shares at all. Our index funds, all our index fund lovers out there will be crushed. Why not invest in shares?
For me, right here, right now, it's a bit of an awkward situation. It has been for the last couple of years, where interest rates have gone from super stimulatory levels, where equities went nuts. You put interest rates close enough to zero, and you watch other asset markets go for it, and equities went for it, right?
Yep.
Now we've seen interest rates ramp up, and equities have kind of done this over the last couple of years.
Yeah.
Now, I'm good friends with a few, fund managers here in New Zealand, and very clever people, cautious, sitting on a bit of cash right now. They know that things are still, mixed at best.
Yep.
When they see interest rates being cut, you watch them pile in. But between now and then, is that 3 months, 6 months, or a year? I don't know. But in that time, these guys and girls are going to get off their hands, get the cash out, and I can see them coming in.
Yeah. Well, let's talk about that though, Jarrod.
Yeah.
So let's get you off the fence and get you making a call. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
The OCR, imagine you're making the decisions. When are you starting to cut the OCR?
By November, and that's me being cautious. I potentially, could go earlier than that, but let's say I really want to confirm inflation first.
Yeah.
And then November I'm cutting, and I'm not mucking around either. I'm not doing 25 and then sitting for a couple of months. I'm doing 25 every meeting until I get the cash rate back down to 3.
Yeah.
Not mucking about. There's no point mucking about. When you've decided to cut, when you've beaten inflation, off you go.
Yeah.
That's not priced into the market. There is a lot of cuts priced in, but not that terminal rate of 3.
Yeah.
That to me will then fuel the confidence, businesses, all that good stuff, but equity markets as well.
Immediately puts a smile on my face when you say start cutting every meeting. And Mike, if we're talking about the OCR, cutting and getting to 3%, for those that don't know, what does that mean for their home loan rate?
Yeah, well, I mean, it's basically where the Reserve Bank's indicating banks to price their residential rates. So it won't be 3%. If the OCR is 3, there's going to be a bit of margin in there, a bit more, but that's probably more around a long-term good interest rate as opposed to a long-term average interest rate, I think.
Yeah.
But that would be phenomenal for everyone who's rolling off those 6s and 7s.
Yeah.
That's a huge confidence boost for them.
Yeah. Okay. And so where do you see, not the OCR, but interest rates sitting? Because there is the whole question around, 7% is actually not that high
historically
when you consider historical, but then obviously debt levels, and you go, well, what is normal now? What's if 2% is way too low, 7% is way too high, what are we sitting 4 or 5 long term?
Yeah, so we talk about the neutral cash rate, which is going to bore everyone that's listening.
Not
right
me.
Now. Yeah.
We'll turn the cameras off.
Yeah.
Leave the two of you to it.
But basically, the neutral rate is an interest rate that's not hurting you, and it's not stimulating or exciting you either. It's just a boring rate that doesn't do anything, right? So we originally thought it was 2. Now we think it's closer to 3 for a variety of reasons. It doesn't matter. So if that's where the cash rate will go to be neutral, well, we're at 5.5. So there's a big drop down. And just imagine mortgage rates fall by the same amount.
Yeah.
And there you are.
Yeah. And if you put that into somebody with $1 million mortgage and they're paying $70,000 in interest, and that drops to $50,000 or $45,000, an extra 25 grand of after tax income is incredibly material. I can imagine next year a lot of the conversations we're going to be having on the podcast is as people roll off their mortgage rates, just going like, keep your mortgage repayments the same. You're
I
not
know,
used to them.
yeah,
That'll be the battle of 2025.
Yeah, and it's interesting,
and that's
for
good
us.
advice.
Yeah,
it's proper.
Yeah, and it's been interesting for us trying to give advice on what people should do with rates, because those short-term rates at the moment are so much higher. And I'm saying like, yep, if you can bite the bullet and just take the pain for a little bit longer, you'll be rolling off eventually. But you really put yourself out there with your prediction, because if I'm wrong, and let's say the ANZ person is right and she's got it right and it all goes up, I'm owing a lot of people a lot of bottles of wine. Like it's you've really stuffed it.
Yeah. But even the ANZ view is interesting, right? It's like we go harder, but then we're still cutting. And not that long. So, if you're fixing for 6 months now, well, you'll actually miss the rate hikes that ANZ are talking about.
Yeah.
And then even if they do hike, ANZ and others are all calling for rate cuts pretty soon anyway.
Yeah.
So, thinking short term, like you were saying, fixing for 6, 12 months, 18 months or whatever, around there, we're all on the same page in saying that rates will be being cut by that point.
Okay. And then if you look at, let's say, like 2025 and interest rates are starting to come down, you're talking about like a cut every meeting, or however long that takes, just imagining the impact to business confidence, and then the impact to GDP. And I recall a few years ago, New Zealand being like the rockstar economy at points under John Key. Do you think there's that thing, you look at the S&P 500 versus the NZX 50 performance, where NZX 50 went nowhere, S&P 500 did like 26%. Do you feel like that really big year for New Zealand might be
Rockstar? That's great PR from John Key's team. I'll tell you
what.
what.
They got some good people working for them. They're just not copywriting their songs properly. Do you see like that really stellar year for New Zealand? Maybe 25, 26, 27. Is that too hard to say?
No, well, that's kind of what we've got to put our heads around, right? Because that's exactly the sort of time frame we're forecasting, and it's all important for the bank to, what is the economy going to look like this time next year? Well, actually, we think it's better. We think the economy's better balanced, right? The labour market's better balanced with the supply and demand of workers. The housing market's better balanced, given the what it's been through, and hopefully we're seeing supply picking up. Confidence is improving amongst most businesses, particularly agri. I think will start picking up again next year. All that stuff points to a far better performance next year than what we had last year.
Yeah. The other interesting thing is I noticed, and hearing a little bit about like a delay from boomers around looking to exit and sell their businesses and going, COVID came and we're just going to hold tight for a period of time to get the valuation. There must like the switch of debt for younger generations taking on new businesses, those going into retirement, having cash and deciding what to do. There'll be some quite big switches, I'm guessing, in terms of the economy in that way as well.
Yeah, so our demographics is massive. The demographic forces at play have driven most things since the 80s. Whether we admit it or not, it's true. The fact that we've got an aging demographic has driven a lot of what we've seen over the last 40 years, including inflation, right? So there's going to be an unwind of that, right, as the boomers retire and sell their assets down. We've seen quite a delay in boomers. So 2008, they might have wanted to, retire then. They didn't. They had to push over, and now you're saying the same thing's happening again. People are working longer, that is continuing to drip feed through, and it's going to be an interesting dynamic as that the assets are sort of passed down from one generation to another.
Cool. And so let's jump on to our next question. So if you were to use 3 metrics to predict the economic cycles going forward, what would they be?
Well, first I have to give a plug to our own data.
Yeah.
Like as a bank, anyone who's worked in a bank will tell you that we have the coolest data set you'll ever see in your life. So we've got serious data, and we love looking at it. It's high frequency, get it by the day.
Yeah.
We see spending on our credit cards, debit cards, and it gives us a really good insight as to what's happening. I think Kiwibank's got like 1 million credit cards out there. So, it's not a small number. and we get a really good handle on spending patterns, and it's faster than most data points. Most data.
I'm just thinking about like inflation as a lag indicator, right? While you're getting live data.
Yeah.
How I don't want to say easy because I'm sure it's very, very complicated, but surely that data is very helpful to work out where inflation is heading.
It is. Yeah, it is. Some of the things that make it a bit complicated is that we're a small bank who's expanding, so we don't know how much of our numbers are just the fact that we're taking on more market share, which is fine. But as you say, we've just put out our spending tracker now, and nominal values pretty much unchanged on last year.
Yeah.
So we've spent the same amount as we did last Christmas. Wait a minute, inflation rose 6% over that year. So therefore, your volumes are down. So that gives us some really good insight. We saw our credit card data turning at the end of 2022, which is when we put our hand up and said, okay, they've done enough hikes. We were really early, but I was like, we've seen it on our data already. And it's just got worse over the year. And we're looking at our credit card data going, a lot of people are hurting. They're having to spend more money on petrol, so they're cutting spending on household furnishings, for example. They're cutting spending on, all the other stuff which is non-essential because their essential spending has gone up so much.
The data that banks have and the stuff you can do with it is absolutely incredible. On a really, really micro level, when I was working in the UK, we had, I think it was like 3/4 of all bank transactions coming through our data centers, and we could pick the one person who spent the most on McDonald's in the whole of the UK and single this person out. And I was like, man, I lied. That is it was the trip frequency and the average spend was through the roof. I was like,
this is a Big Mac as a thank you.
Oh, we were just sitting there. We were gobsmacked. And like, these are retail customers. I was like, yeah.
Okay, so
we don't have that.
Just to be clear,
we aggregate our data, and we certainly don't have people's names.
So just to be,
I added them on Facebook.
as a little bit of context, Jarrod. Mike has Sind in the UK, exploiting all that data. He is now a mortgage broker trying to help people into their homes and achieve their goals. Okay, so that's one metric you would use, the spending on credit cards and debit cards.
I think it's just because it's so timely. Like we get it on a day-to-day basis. The other, being a small open economy, the first thing you do is actually look overseas, right? And getting a handle on what's happening globally. I'd be looking at the manufacturing data, right? Whether it's the surveys or hard data, getting a handle on what's happening, global economic activity, breaking it down across our trading partners. What's happening in China? Oh, not good. What's happening in India? Fantastic source of growth for the next 50 years. What's happening around the world gives you such a backdrop for how we're likely to perform. I'd start internationally and look.
What about the quality of that data? Like I know, say for China in particular, there's a bit of a, sometimes it might look a little bit better than it is in reality. How reliable is that data?
Well, to put it bluntly, some of the data is quite questionable. But those who've been around a while might look at other things like electricity usage in China. Oh, okay, that gives us a pretty good read. Or there's other data that you can look at for places like China
as a proxy to try and get a finger on what's happening.
Exactly right. Yeah. And China is obviously going through a very rough patch right now. And the growth that we saw out of China over the 90s and into the 2000s, we're not going to see it. Their population's peaked. Okay, where's the growth that we're going to get? India. Right, and the government's right in that they need to pursue free trade agreement with India. My understanding is it's getting them up to our level of a free trade agreement. There's no such thing as a free trade agreement. It's just
who's doing what.
But we need to get them up to our level. I think we could possibly drop down a bit. We need to get something done because if the Australians can do it, for God's sake, surely we can do it.
And I guess the slowdown in the Chinese economy has huge implications for the Australian economy as well, given the amount of raw materials they buy.
So we almost get hit twice by China's slowdown, because our largest trading partner, China, that hurts us directly. Second largest trading partner, Australia. Yeah. Oh, their largest trading partner is China. So you kind of get this.
How much of a risk? I mean, so we've talked about how, you know, the future's, you know, looking relatively bright, and there's the risk of, you know, just our size and China, you know, sneezing and us catching a cold. Yeah. How much risk is there in terms of our, you know, what the future looks like over the next couple of years? Say China's growth numbers, maybe India, we don't get enough from India that we need to replace China. What's the risk look like?
Oh, I mean, I think it's a big risk. Yeah, and you haven't mentioned geopolitical risk yet, which is probably the one thing we worry about the most.
Yeah,
China is a very good trading partner of ours. Yeah, but in bad times, I could imagine them being a very bad trading partner as well.
And it's not like we have a lot of lean over them. Yeah, there's not much purchase there. Yeah,
yeah, and some of the discussion coming out of Europe at the moment, you know, investing in, I guess, making sure they can stand alone from a military perspective. It just feels a little bit like at the moment, doesn't it?
It's like you can't get away from it, right? You've had this big shift started a while back. Well, pretty much after 2008, you had this shift of voters more and more towards populist politicians. Trump was a classic example of a populist politician that, you know, got enough, and it does worry me.
Yeah. Cool. And then any other sort of key metrics you'd look for outside of those, the spend data and the global manufacturing data?
Yes, it would be locally. It would be anything on the labour market. Yeah. Most things, you mentioned it before. Most things play out in the labour market, right? So the number one thing that we try and forecast is the unemployment rate.
Yeah.
You know, if we're right and the unemployment rate goes from 3 point something to 5 point something, that's great. That's a soft landing.
Yeah.
Any high frequency data on you know, job ads or you know, anything around the labour market's key. Because we're looking for signs that we might be wrong, and we're up at 7 or 8, you know,
which has real impacts.
Yeah.
Cool. I gotta say, I'm feeling a bit better about the world after talking to you today, Jarrod. Especially the main thing was me thinking like cut after cut, meeting after meeting. I know it'll take a bit of time. There's something to look forward to, right? Just around Christmas, you know, it should be nice. Well, Jarrod, thank you very much for joining us. We know you're a busy man, so we really appreciate you coming along and sharing your opinions. And thank you everybody for listening. Please make sure to give us some feedback on this episode. We're going to hunt Jarrod down. I found he doesn't live that far away from me, so it's very easy for me to track him down outside his front door. Please make sure to give us a subscribe, a review, and a like. Big thank you to Partners Life, and we'll see you next time.
Cheers.